life cycle costing, the way selling price is decided as um, selling price is equal to cost price plus profit. But what do we have under cost price? So that is the important point. What do we have under cost price? Cost price usually includes whatever are the costs which are incurred during an accounting period, or for the operational purposes, operating cost, all the operating costs are considered, add them up and decide on what is the total cost, add a profit margin, and determine the selling price. Okay, so that's how the regular way in which it is done. But life cycle costing suggests that, see, it is not only that there are operating costs which are incurred. Operating cost starts from, we see that the costs start from purchasing of raw material. So raw material is acquired, then raw material is converted into finished goods, and then they are delivered to the customers. So starting from the cost which is incurred to acquire the material, supplier, from the supplier to the uh, customer where the sales are made. So that is what all the costs which are incurred in this process: acquiring raw material, converting raw material into finished goods, marketing, distribution, promotional activities, all of them, ultimately delivering the good to the uh, the customers. But before the production start, before acquiring the raw material also, we see that there are certain costs which are incurred. We call them as the initial cost, like research and development cost is incurred. Then we see product designing, process designing, those things are also incurred. So we have designing costs. So they also have to be recovered from the revenue which is generated. So this is designing cost. These costs are incurred. See, without research and development, without designing cost, the activity of production cannot start. It cannot start manufacturing. See, all that have to be established. They have to be set up. Then things work out, and then they start manufacturing. Then there are certain other costs also, what we call them as, see, once the product is delivered to the customers, it is not the end of it. There would be some more cost which can arise even after the product is delivered to the customer, like the sales are made, product is delivered. After that, let's say if there is any maintenance which has to be taken up, if any repair comes out. See, if the company is offering some warranty or guarantee period or something like that, during that period they have to offer services, and at that time there is no cost charged from the customer. So it's free of cost services which are provided to the customers. So we see that beyond the sale also there are certain costs which are incurred, called as after sales service cost. So this is after sales take place. There are still some more costs. Now these costs also have to be recovered. So before the production and after sales service cost also have to be recovered. So now these things are not considered as the cost incurred during the operating year, and these are not the operational costs. So generally they are not included into the total cost and to decide what is the cost price per unit. So that is one issue there, wherein later on, after everything is done, if these costs also have to be recovered, if these costs have to be recovered, then the revenue may not be sufficient to absorb these costs. So what does life cycle costing suggest? It suggests that, see, at the beginning of the production, at the beginning, in the beginning stage only, it has to be identified as to what is the life of the product. So the first thing what has to be estimated is what is the life, how long will this product be sold in the market. So life has to be estimated. During this life, the total production which would be taken up, the number of units which would be produced also has to be estimated. So let's say if the life of the product is for 5 years, so in each of the years, how many units would they be producing and selling is also to be estimated. They have to estimate that also. Then from the beginning, from the initial stage till the end of that. So this concept is also called as from cradle to grave, starting stage, initial stage until the end. Even after the sale is done, also even at that stage, also if there are any costs which have to be incurred, they also will have to be considered. So every cost which would be incurred during the entire lifetime has to be ascertained. That is the total cost during the lifetime. Since the total unit during the lifetime is also ascertained, find out what is cost per unit and add a profit margin, decide on what is the selling price. So by this way, the selling price which is decided after considering all the cost, initial cost and after sales cost also, when they are considered, then in that situation, all of them would be absorbed by the revenue which is generated from sale of the product. So that is the concept, and it says enables a product's true profitability to be determined at the end of its economic life. So they will be able to understand what is the overall total profit which they have realized at the end of the life of the product from recovering all the cost from the revenue generated. So that is the concept of life cycle costing. Is it clear? Is it clear? Okay. What are the implications? The implications are pricing decisions can be based on total life cycle cost. So all the cost would be absorbed by the selling price, which is decided rather than simply the costs that are incurred for the current period. Then decision making or timetable of life cycle costs helps show what costs need to be recovered. So when they are considering all of them, what are the costs which are incurred at various stages of the product life cycle, what are the total costs which are incurred, what has to be recovered, all of them can be understood thoroughly. Life cycle costing reinforces the importance of tight control over logged in costs such as R&D. See, if these things are not brought into the purview of what is total cost, any amount can be incurred as R&D. But now, because R&D also is under observation, because it is included into the total cost, because that cost also has to be recovered from the selling price per unit. Now selling price per unit also cannot be anything what they decide, that we have already understood. That in situations where the demand, when the competition is severe, the demand gets affected by the selling price. So there can be a tight control on all the costs, because the selling price um, should not have a negative impact on the demand. If R&D is any cost which is incurred, then that will have an impact on the selling price. So for that reason, we see that there would be a tight control on R&D cost. Performance reporting, life cycle costing, cost to products over the life of over their entire life cycle to aid comparison with product revenues generated in later periods. So the entire life is considered life cycle costing cost to products over their entire life cycle. So in the later stages, we see that there are not much in the decline phase. Um, in the later stages, the revenue generated will decrease because that would come to a decline stage at the end of the life of the product. So then, but still the cost would be high even after the product life is also over. Still, after sales services cost are also there. So here it says that um, cost to products over the entire life cycle to aid comparison with the product's revenue generated in later period. So here if they uh, um, adopt life cycle costing, then it gives them a possibility to look into what is the revenue which is generated in every stage, especially the later stage when the revenue actually decreases. But the revenue which is earned from deciding the selling price according to life cycle costing helps them to meet those costs also. Okay, so that is about the performance reporting. The next one, the next method is throughput costing. But then right now, we will not do throughput costing. There is one technique called as key factor analysis, which we will learn in the coming chapters, cost volume profit analysis. After that, part of decision making under cost volume profit analysis is key factor analysis. A modified version of key factor analysis is throughput cost. So first let's learn what is key factor analysis. So as of now, I'm putting it aside. We will not take it up this one, but we after we finish doing key factor analysis, immediately we'll come back to throughput costing and take it up because a modification is made to the concept of contribution and it proceeds further. So we will take it up at that time. Then in under special accounting techniques, the last topic is what is environmental cost. Now, environmental management accounting accounts for all the environment related costs. So organizations, some of the organizations, because of the nature of work which is done, there is a impact on the environment. The production process leaves a negative impact on the environment. So how do they account their costs? So there are certain things which they are supposed to follow. They are supposed to comply with what are the rules and regulations in such situations. So environmental costs or environmental management accounting accounts for the environmental costs. So these environmental costs can be categorized as internal costs and external costs. So there are two different sets of costs which they would be accounting for. Internal costs, like since there is an impact on the environment, just a minute, let me put it to full view. Okay, so this is a full view. See, there are internal costs and external costs. What are internal costs? So, because there is an impact on the environment, they have to um, have improved systems. The equipment has to be um, improved version because because of the pollution which is generated, they have to invest a lot on the equipment, the system in which there will be less impact on the environment. So they have to spend on improved cost. They have to look into what is the waste disposal cost, product take back cost. Then we see that regulatory costs, they have to comply with certain rules and regulations which are listed out for such organizations. So there are something, maybe the what do they do with the pollution which is generated, the waste which is generated, how do they um, I mean dispose of that or treat that waste which is generated, that industrial waste, whatever is generated. So whatever are the norms which are laid out for them. So whether or not they are complying with that. So regulatory costs. So they have to ensure that they go by the rules which are labeled for them. So in this process, there may be certain costs which they have to incur. So regulatory costs, upfront cost, and back end cost. So to begin with that work, so initial cost, whatever are required, that is upfront, and then back end, and then even when the unit is shut down, unit is closed also, they cannot discard the things which they have used in their industry just like that. Sometimes the equipment cannot be discarded, it has to be dismantled and do something about it. The materials which they have used, so there have to be there should be some way they decompose that, dismantle that, discard that. So certain measures also have to be taken to settle all these things. So then upfront cost, back end cost, all these things are incurred internally by them. External costs are imposed on the society. So they, because of their activities, there is an impact on the society. So something which is imposed on the society at large, but not borne by the company that generates the cost in the first instance. What is that? So what is the amount of carbon emission? Here we see carbon emission. Then usage of energy and water. How much? What is the point in usage of energy and water? So, um, because the industry is set up in this present generation, in this present period, during this present time, they cannot utilize all the resources whatever are available. There should be some amount of resources which should be left out for the future generations. So that's called as sustainability. You must have watched an advertisement which comes on the television which says that the parents were first called in to a room. They were handed over the crayons and ask ask the parents to draw something using the crayons. The parents utilize all the colorful crayons. Then after they leave the room, then kids were brought into the room, and the remaining crayons they were given. So we see that only the black crayons were remaining. All the colorful crayons were utilized by the parents. So when the black crayons only were there, the kids are left to use only those things. You must have watched this particular thing. So what does it suggest? Whatever is available should not be consumed by the present generation. Something should be left for the future generations also. So that concept is called a sustainability plan. Sustainability. So consume the energy and water resources in such a way that there's something left for the society. So if this particular unit, this particular company is consuming a lot of resources, maybe less will be remaining for the future generation. So that is an external cost. So because of their activities, the cost is borne by the society. There is an impact on the society. They will have to bear the cost. So that is usage of energy and water. Then, as a part of the setting up their businesses or industries, there may be some forest degradation. Healthcare issues can arise because of the pollution. Healthcare issues may arise. Then some social welfare costs also have to be taken up. These are the costs which have to be accounted in case of environmental management accounting. So now, in such cases where environmental management accounting is followed or environmental costs are accounted for, how do they account for the cost, or what accounting systems or accounting methods are adopted? Generally, to go with environmental management accounting uses. Now you have to remember this one because this gets repeated in APM also. So APM also touches upon environmental management accounting. What are the uh, costing methods which are used in case of environmental management accounting? um, Theoretically it would not be explained because it's not a part of the content, but the cases discuss about these things. So what are the various things which are used? So we see ABC, life cycle costing, flow cost accounting, and input output analysis. These are the four methods which are used. Um, so the question can directly appear in the case stating that because of this particular organization, um, their process, there is an impact on the environment. Therefore, suggest what accounting methods can be used or what are there. Or there is a discussion in the case about what accounting methods should be used. So you have to elaborate on that. The case may not be exclusively on this, but a part of the case can be there. There, while explaining, maybe nothing is explained in APM about what is ABC, what is the other three pages, what we are going to discuss about the flow cost analysis, life cycle costing, and ABC. Of course, we have learned now. Flow cost accounting, input output analysis, those things will not be repeated there. But from this knowledge, whatever you've done now, you will have to elaborate on those cases and write the answer. What is the use of ABC? Now, how is it useful here in case of environmental management accounting? We see that environmental management accounting has to account for all the costs. So there would be direct costs, there would be overhead costs also. So when overhead costs have to be accounted for, allocated, in that case, traditional costing was not very helpful. Yesterday we have discussed. So activity-based costing help can be taken to allocate the overhead costs appropriately. Okay. So environmental costs hidden within overheads are separately identified. Using the cost drivers, the overhead costs are allocated. Then the product cost will become more realistic. So overhead cost allocation can be taken up by use of activity based costing. So ABC can be used in case of environmental management accounting. Next one, it's about the life cycle costing. So life cycle costing, it considers all the costs which are incurred right from the initial stage till the um, final stage. So even after they shut down their business also, they will have to take care of certain assets, equipment, the way they have used the natural resources. So they have to decompose all of them. So every aspect of it, right from the research and development, designing. Now, uh, the initial costs what are accounted for improved system. But if they have to have an improved system, there should be some research, some designing cost which have to be spent. So they have to incur costs at the initial stage because to see that there is less impact on the environment, the designing cost, development cost, they have to be incurred. Plus, at the end of it, let's say they are using a natural resource. A mine is used to attract something out of the mine. Then um, they cannot leave the empty mine just like that. They have to take up some land filling or something. The empty space has to be filled with something so that they take care of it properly. At the end of the product, at the end of the life of that particular unit also, they still have to ensure that their equipment is dismantled, discarded. Certain things like they have to decommission. All of them also are costs which are incurred by these units where environmental management accounting is followed. So if there are costs before the production and after the final lifetime, then they have to be taken care of it. Life cycle costing is more suitable. So adopting life cycle costing they can decide what is the cost price of their product so that the appropriate selling price can be decided. So life cycle costing is also useful in case of environmental management accounting. Then we see flow cost accounting. So what is flow cost accounting? They are keeping a track or flow of the material. So whatever is inputted, we look into that. Whatever is the input of material, that should come out as the output. But does it happen all the time? The input and the output do not match with each other, because all what is introduced into the process as input is not completely processed and comes out as output, but some part of it gets lost as a normal loss. Material can spill out on the way. If it is, it can evaporate, it can leak, it can fall on the way, it can be broken. So we see that all input would not be ultimately converted into output. Rather, some of them get lost because of the process. The nature of process is such that a percentage of the amount of material gets wasted. It gets lost. So because of normal loss, we see that the output is less than the input. Now, in such case, um, someone wants to say something. Abhinavu, do you want to say?
Nothing, ma'am.
Um, so flow cost accounting keeps a track of what is the flow of material, how much was inputted, and what was the output which was generated. So that track is maintained, and it also accounts to normal loss. So then, if the normal loss is accounted, suggestions can be given as to how to minimize their normal loss. So um, the normal loss reduction will enable them to have a higher output. Let's say if this normal loss is brought down, the impact which will be there on the output is output will increase. So normal loss reduction will result in the output increasing. So looks at material flows and losses at different stages of the product process. Then this aims to reduce material quantities and wastages. If the wastages are reduced, the impact will be there on the output. Output can be increased. So related to input output analysis. So the extension of flow cost accounting. Now here it is only about the material which is introduced, the number of units which are introduced, how many units are lost, and how many units are produced as output. Extension of this is input output analysis, wherein the value of these material is also accounted for. Accounting for outputs both in terms of physical quantities and at the end of the process in monetary terms too. So input is accounted, input of material is accounted along with the value of the material. So how much value of material got wasted as normal loss, and what is the value of the output is also accounted. So that is input output analysis. Technically speaking, nobody is going to explain to you at that point of time, but it is expected of you that you remember these things because you have to elaborate in the case if a case appears or comes in the exam related to environmental management accounting. Okay. So with that, we end the topic of what is specialist um, cost accounting techniques, specialist accounting techniques. Of course, we've left one topic called as throughput analysis, but we will also take it up after we do key factor analysis. The next concept is cost volume profit analysis. Okay, now we are here in Word file. Let's see the explanation here. Make a note of all the formulae and then we'll proceed further. We'll go back to the PPT and then continue there. The title of this particular chapter is Cost, Volume, Profit Analysis. So, sales minus total cost is equal to profit. So that is what is ascertained all the time. How is profit ascertained? How is profit calculated? Is by deducting all the cost, the total cost from the sales margin or the sales revenue generated. Then we have the profit margin. So that's the equation. That's the concept what we all understand. But this particular technique, cost volume profit analysis, also called as, there's another term for this one, also called as marginal analysis. Now, this analysis suggests that the cost should not always be looked at as total cost, but this total cost should be looked at as variable component, the variable cost and the fixed cost. Variable cost is a cost which varies proportionately with the output. So, the other day we were discussing about making a table. So, one piece of a table, what's the material cost? So 10 tables, what's the material cost? Let's say, for example, if to make one product, it is $2 material cost which is required. So if one table is made, $2 will be incurred. Two tables, then we see 2 into 2, $4. 100 units are made, 100 into 2, 200. 1,000, it goes on like that. So it changes proportionately with the changes in the output. So such a cost is called as variable cost. So the um, change happens, it's reflected because there is a change in the output. But there is another cost which is called as fixed cost, which remains fixed within the relevant range. What does it mean? So let's say if they have a maximum capacity. So starting from zero number of units till the maximum capacity. Zero number of units to maximum capacity, the cost is the same. It would not change. Let's say there is there is an item called as factory rent pay. Will factory rent keep changing with the output which they produce? So in that factory premises, if they can produce, let's say 1 lakh units, until they reach that capacity of producing 1 lakh units, factory rent will not change. It would be the same. It will change if they exceed that capacity. If they produce beyond the capacity, then in that case they will have to um, uh, hire another premises also. So then their cost increases, but within that range, the cost doesn't change. So it is the same within the range. So that is a cost called as fixed cost. So here marginal analysis says that, see, because there is one component, fixed cost, which does not change, so it is completely irrelevant for decision making. Any decision which is taken, there is one component of the cost which remains changed, it doesn't get affected. So it is considered as an irrelevant cost for decision making. So the suggestion is that the equation should not be as simple as sales minus total cost is equal to profit, but divide this total cost or categorize them into variable and fixed cost and decide another equation. So the equation is, first from the sales, the variable cost is deducted. The total cost is not deducted, the variable cost is deducted. But after a while, even the fixed cost is also deducted. but separately they are deducted. So right immediately after the variable cost is deducted, so whatever is the amount which is available, see one type of cost is deducted, so it's called as a profit, which is a controllable profit because variable costs are controllable. So sales minus variable cost is controllable profit. So there is a term which is given to this one. It's called as contribution. Sales minus variable cost is contribution. So from this contribution, this contribution will take care of recovering the fixed cost. So after fixed cost is deducted from that, the resultant figure is the profit. Basically, we are arriving at the same profit. This profit and this profit, the profit of from the two equations, they are same, but in between this total cost is split into the variable component and the fixed component. Separately they are deducted. So right after deducting the variable cost from sales margin, sales revenue, the profit which is arrived at is called as controllable profit because variable cost is also controllable. So they are split into two parts, variable and the fixed cost. So sales minus variable cost is contribution. Contribution minus fixed cost is profit. Done. Then this is a profit which is a controllable profit. Variable cost also can be controlled. So controllable cost is deducted. The profit after that arrived at is the controllable profit. So that is relevant for decision making. So it should not be this profit, the total profit or the net profit, which is finally arrived at, considered as profitability, but the profit which is controllable, that profit is to be taken into consideration for decision making. Because no matter what is the level of activity, right from zero number of units until the maximum capacity, fixed cost remains fixed. So let's see what is this particular aspect of it. On a scale of output, let's say that starting from zero to the maximum capacity, if we put the number of units or the output on the x-axis, from zero number of units until they arrive or until they reach the maximum capacity. On the y-axis, if we present the cost and revenue on the y-axis, cost and sales if they are presented on the y-axis. So here, this is cost and sales. See, fixed cost is a cost which is incurred even when it is zero number of units. So starting from zero number of units until the maximum capacity. So zero number of units till the maximum capacity, there is a cost which is incurred and remains the same. It doesn't change. So that is the fixed cost. It is incurred even when the output has not started. Even there are no number of units which are produced. Even at that stage also, there is a cost which is incurred, and that cost is fixed cost. It it remains the same till it reaches the maximum capacity. But another cost which is a variable cost, it varies proportionately. So if it is 1 unit, whatever is the cost per unit, at that amount it increases. So what if it is zero number of units? Let's say if the cost is $2 per unit. So 1 unit, two units, four, 3 units, 600 units, 200, goes on like that. So what if it is zero? Zero into two is zero. So it starts from origin. So it keeps rising from the origin and increases proportionately. This is called as variable cost. Okay. Now the total cost is the total of both the variable plus the fixed cost. Variable cost plus the fixed cost is called as the total cost. So the total cost will start from this point. This is the fixed cost point. From this point, if it starts and rising, it keeps rising. So it's not zero, because at zero number of units, one portion of the total cost is already incurred. So from here, it keeps rising. So the total cost keeps rising from the point of fixed cost, and because from there the variable cost keeps increasing proportionately, the cost also increases, but we do not see that the overall impact is proportional. Okay. Sorry about that. Total cost increases, but from the fixed cost point, not from origin, not from zero. So because until at zero number of units, it is already fixed cost is already increased. So it starts from here and keeps rising. It rises because there is a variable cost component, keeps rising as the number of units produced are increasing. Now comes sales. If the production is zero, can they sell anything? Nothing, zero. But as the number of units produced and sold increase, we see that the sales rises proportionately. No matter how I have drawn, it is a straight line only. Assume it's a straight line. Okay. So what do we see here? There is a point where these two lines are intersecting. So at a point where the sales curve is intersecting with the total cost curve, so they both are meeting. When sales is equal to, if we see sales is equal to total cost, there is no amount of profit or no amount of loss. So sales is equal to total cost is a situation. Now when they both meet each other, that is the point where there is no profit, no loss. See, if sales is less than total cost, let's say if sales is less than total cost, what happens? Revenue which is generated is less than total cost. So revenue will not recover the total cost. So what will they have? They will have a loss. If sales is below the total cost or less than the total cost, they will have a loss. But if sales is more than total cost, so from sales, if the total cost is deducted, the resultant figure is called as profit. So this is the concept graphically when we present it. Of course, there are graphs there in the PPT also. but I want it, to explain that while drawing it, so it would be uh, clearer to understand. Of course, it doesn't look very neat and nice, but the logic has to sink into your mind. So here we see that uh, the concept of splitting the cost into variable cost and fixed cost talks about what is the impact it would have on the profit. There is one component of the cost which is fixed, which does not change. It remains fixed until it reaches the maximum capacity. There's another cost which keeps rising, proportionately variable cost. Total cost starts from the fixed cost point and it keeps rising. Sales is not at that point, it is at zero when it begins, and it keeps rising until the sales value becomes equal to total cost. They will not be able to realize any amount of profit. Only once the sales curve exceeds the total cost curve, it goes above the total cost, then they start earning profit. Below that point, until the sales curve is below the total cost, they still have to bear the losses, incur the losses, and bear them. So that is the concept. That is the concept of the cost volume profit analysis or the marginal analysis. So the marginal analysis talks about splitting the cost into two parts and then having the equation framed as sales minus variable cost is equal to contribution. The contribution will absorb the fixed cost and the resultant figure is profit. So that is what is the equation. Now, based on that, there are certain other equations also what we have to learn. I will write the formula on the sheet. You also please make a note of it. You also please record that. The first one is called as contribution by sales ratio is equal to, as the name itself says, that we see contribution by sales into 100. What is the logic here? If sales is taken as the base, if sales is taken as 100%, contribution is also one profit. What is that profit? That is controllable profit. So the margin or the controllable profit margin or the contribution margin is how much. So that is the logic here. So contribution is what percentage? Contribution by sales into 100. Contribution into 100 by sales. So that's the logic here for the first one. To understand what is the percentage of controllable profit is the concept of contribution by sales. So some of the Indian textbooks do not mention this term as C by S ratio, but they call it as P by V ratio, PV ratio, what we call it as PV ratio. So profit for volume of sales. Volume of sales, if it is 100%, profit, which is controllable profit, that profit margin is how much? So contribution by sales into 100. Second one. The second equation is, you also make a note of it, break even sales, but this is in terms of units. What is break even point? Break even point or break even point, BEP, what is called as BEP. How many units should they sell that they break even? But what is break even point? Break even point is a point where there is no profit, no loss. That's right. No profit, no loss. So when there is no profit, no loss is a point where we see that sales and total cost are equal to each other. They both are equal to each other. They intersect at a point. That is the point of break even. So on the graph, if we present it, see if we extend a line touching the x-axis, whatever are the units here, these are the units of break even point. This is the point, or these are the number of units. If they sell this many number of units, they would reach the break even point, or they would reach a point where there is no loss and no profit. Initially there is all loss. We see that initially there is loss. After they cross the break even point, there is profit. So at what level will they cross that phase where there is loss? So they come to a point where there is no profit, no loss. Fine. The equation wise, if we are talking about the equation will be as the total fixed cost divided by contribution margin per unit. So that is the equation. But what's the logic? Why are we writing this one? So if there is no profit, no loss, let's say if this is the equation, if we look into that, profit is 0, no profit, no loss, profit is equal to 0. If we take fixed cost to the other side, contribution and fixed cost, when both of them are equal, or contribution earned is sufficient enough to recover the fixed cost. So as much as the fixed cost is, if the contribution earned is the same amount, that is the point of break even point. If it is profit is 0, fixed cost comes to the other side, contribution is equal to fixed cost. So when we equate contribution is equal to fixed cost, that is the point where there is break even. So we have to see that fixed cost and contribution should be equal. But what did we write here in the equation? For example, let's say if we have to find out what is cost per unit, how do we calculate what is cost per unit? Total cost divided by number of units. We have total cost divided by number of units. If that is the case, let's say if units are taken to the other side, the equation will take a different form. What is the equation if we are trying to find out what are the number of units? The equation will be total cost divided by cost per unit. Do you see that? If we have to find out what are number of units, we just have to bring cost per unit to the denominator. So this will be cost per unit. We are applying the same logic here to find out the number of units of break-even point. To find out the number of units of break-even point, we are equating the fixed cost and the contribution margin, but fixed cost divided by contribution margin per unit. That is the logic what we are applying. I hope it is clear. We are equating fixed cost and contribution, but because we have to find out the number of units which have to be produced so that they break even, for that reason, we have in the numerator the total fixed cost and in the denominator the contribution margin per unit. That so that gives us, that helps us to find out how many number of units should be produced and sold, that so that they break even. Now another equation about let me erase this particular so the graph is also, I will show another graph, but I will erase the screen, the scribbling on the screen, so that there would be some clarity. Fine. After this, the third equation is about what is break-even point, but that is in terms of The sales value. The value of sales is just not the number of units, but it is the sales value. See, if it is break even, we just have to equate the fixed cost and contribution. So the equation would look like fixed cost divided by contribution by sales ratio, contribution margin ratio. We have it as contribution by sales or ratio, or contribution margin ratio, what we call it as. So contribution by sales or contribution margin ratio. Fourth one. Fourth one is the equation of what is desired sales in units. Desired sales in units is equal to, see, at break even point, there is no profit, no loss. See, at break even point, there is no profit, no loss. But any other level, we see either there is a loss or profit. There would be a loss or profit. Below the break even point, there is this area is all loss. This region, there is all loss because the sales revenue is below the total cost. So the total cost is above the sales revenue. So more cost is incurred than the revenue generated. So there is loss. Above the break-even point, because sales has overcome or exceeded the total cost, there is profit. So this region is all profit. So if we have to write the equation about desired sales level, only at break-even point there is no profit, no loss. Any other level, we have either a profit or loss. So the same equation can be adopted. We can take the same equation, but with the change that, the numerator will have fixed cost plus or minus profit or loss. So either plus or minus profit or loss. That would be there in the numerator. So desired sales in units is equal to fixed cost plus profit or loss divided by contribution margin per unit. The rest of it is all we have discussed. So if we have to find out now what is desired sales in units, in sales value, in terms of the dollar value in the next equation, margin of safety. So what is margin of safety? So when we look into what is margin of safety, um, when is the firm safe? Only when the sales exceeds the total cost. So after that, um, I'm really sorry. Only when they cross the break-even point, when the sales exceed the total cost, is a situation where they cross beyond the break-even point. When their sales are beyond the break-even point, they are safe because there is profit earned. So the same thing has to be presented in an equation format. So margin of safety is equal to actual sales which are over and above the break-even sales. So if their actual sales exceed the break-even sales, That is the point of margin of safety. So if margin of safety also can be calculated as margin of safety percentage. If it has to be presented as a percentage, so the actual sales are taken as 100%. Margin of safety sales are what percentage? So in the numerator, there would be margin of safety by the actual sales, actual or budgeted sales, whatever is the term which is used, the sales into 100. So we are just converting that into a percentage, margin of safety percentage. Okay, so that's the equation. So at the moment, learn these things, learn these formulae, um, and we will apply it wherever it appears. So that's the concept of cost volume profit analysis in terms of equations. Let's get back to the PPT and then go through these slides. If the logic is clear, any variation or any way in which that is presented, you will be able to understand. Maybe sometimes we have to find out the hidden values and find out the variables and substitute them in the equation. So that is one thing which has to be taken up. So what is cost volume profit analysis? What is the cost for a volume of activity, volume of sales, and how much is the profit generated? That is, there are two profits, which is one is controllable profit, and what is the final, which is the total profit. Profit is equal to the total profit is equal to the total amount of contribution minus fixed cost. What is contribution is sales minus variable cost, because we've already discussed all the equations. I'm not spending on that. So there is a tabular form in which it is presented as the number of units keep increasing. The contribution also proportionately increases because sales and variable cost increase proportionately. From that, fixed cost is deducted. We see that initially there is loss until a point where it becomes, both of them become equal. Contribution and fixed cost become equal. That is the point where there is no profit, no loss. So that's the point of break-even point. After it crosses that level, we see that profit is earned. Contribution per unit would be the same at all levels of activity, but profit per unit initially we see that it is a loss, and it later on it gets converted into profit. This is the graph. We have already looked into this graph, the point where the sales and the total cost intersect on the x-axis for the output. That is the level of output at which they break even. There is no profit, no loss. Margin of safety is a situation once the sales exceeds the total cost or it exceeds the break-even point. That is the point where they are safe. So this is the margin of safety. So these sales are margin of safety. So whatever is the break-even output here, whatever is the budgeted output. So the difference between the budgeted output and the break-even output is the margin of safety. Contribution to sales ratio is equal to contribution by sales into 100. Then break-even point formula, I gave you both of them. The sales value of break-even point is fixed cost by contribution by sales ratio. If it is in number of units, fixed cost divided by contribution per unit. So then we have targeted profit. See, targeted profit or targeted sales, the same equation can be used. Sales is equal to fixed cost plus profit, because in the numerator now we see either a profit or loss appearing. So fixed cost plus profit by contribution per unit. If it is an activity, the sales value at an activity level, the denominator would be contribution margin ratio. Okay. So the profit volume chart, if it has to be presented, initially there is a loss. The loss comes to the point where there is zero profit, and then it exceeds beyond that as the number of units produced are increasing. At zero number of units, this is the loss, and this loss slightly keeps decreasing as it keeps increasing. From negative zone, it moves to the positive zone. It comes to a point where there is zero, and then beyond that, it exceeds and there is profit. Okay, done. So, but cost volume profit analysis is based on certain assumptions, and that also can be looked at as limitations. The assumptions of cost volume profit analysis, it says that cost behavior is assumed to be linear. Linear is the equation of a linear relationship can be presented as y is equal to a plus bx is the linear equation. So the relationship is presented in this particular format. Y is equal to a plus bx. Y is equal to total cost. So total cost is in a linear relationship. So what does it mean? So we see that a portion of that is, see, A and B are constants, X is a variable. X is the number of units. So the second part of it keeps changing with the number of units. Bx keeps changing, the value of bx keeps changing for different values of x. X is a variable. It keeps changing. B is a constant. A is also a constant. So A can be taken as fixed cost. Bx can be taken as variable cost. So this one is A is fixed cost. Bx is variable cost. So total variable cost keeps changing with the changes in output. So X is output. So this Bx part of it is variable cost. So it is in this relationship. And the assumption is that because they are constant, they would not change. Once it is known what these values are, they would remain the same. That also can be a limitation. It is not that absolutely fixed cost and variable cost per unit, they do not change. So they can be looked at both as assumption and also a limitation. So revenue is also assumed to be in this relationship as um, a linear. A portion of it is earned fixed in proportion, and the other part of it keeps changing along with the changes in the output. So that is again a relationship. So um, for both cost and revenue, the assumption is that there is a linear relationship present. So maybe some portion of the revenue can be fixed revenue, fixed portion which is earned. The rest of it is changed according to the changes in the number of units which are sold. Volume produced is equal to volume sold. There is no concept of closing stock at all. All that which is produced during a period is sold during that period only. No carrying forward of any units into the future period. So that is volume produced is equal to volume sold. Fine. Then they ignore inflation. Any changes in the inflation will result in an increase in the cost also. So if they ignore inflation, then they go with the assumption that once the fixed cost and variable cost are known, they would remain the same. There will be no change in the cost. Then it always assumes a constant sales mix. So the number of units which they would be selling. Mix is a situation where more than one type of product is sold. Mix is more than one type. So let's say they are producing two products, A and B. So the proportion of the units which are sold, let's say if they are selling 60% of A product and 40% of B product. So the ratio or the mix is 40 is to 60. That is assumed to be constant. It would not change. All the time they would be selling in this proportion of 60 is to 40 all the time. That would not change. So these are assumptions. We can also understand that the assumptions can become the limitations also. Is it possible to have the same sales mix all the time? No, there can be a possibility of a change also happening. So that is a limitation also. 1 second. Let me open the PM exam kit, and then we'll take up. So let's work out few questions here. Cost volume profit analysis. Question number 84 is there. Before 84, I think we can let's do 87. Much simpler one. First, we'll do that, and then we can take up the other questions. Um, Question number 87. Question number 87. It says an organization manufactures and sells a single product, the G. It has produced the following budget for the coming year. We see sales revenue is 20,000 units. The value of it is 5,000. Then manufacturing costs are given. Fixed variable selling costs are also given as fixed and variable. Then cost of sales is given. Profit amount is given. If inventory levels are negligible, what is the break-even point in units? So let's um, work it out. Question number 87. We need to know two variables. One is fixed cost and one is contribution margin per unit. So if we take fixed cost, there are two components of fixed cost. So one is fixed cost under manufacturing and one category under selling cost. So let's add them up. Fixed manufacturing cost is 1,600 plus fixed selling cost is 1,200. So add them up, 2,800. Then we have the next one, variable cost, the contribution margin per unit. What's the formula for contribution margin per unit is equal to selling price per unit minus variable cost per unit. So that is contribution margin per unit. Do we know what is selling price per unit? Selling price per unit can be recorded as the sales value is 5,000, but the total number of units is 20,000. So what is the selling price per unit? So when we look into that, 0.25. Similarly, we also have to calculate what is variable cost per unit. Variable cost per unit is equal to, there are two amounts of variable cost, but one is 1,400, another one is 1,000, 400. So add them up, 1,400 plus 400 divided by 20,000. We can now find out what is contribution margin per unit. Contribution per unit is equal to, find out what is break-even point. We can have this one as 2,800 divided by 0.16. 17,500 units. Please make a note in your notebook and then you also work out, use the calculator and then check that. Question number 88. A company manufactures and sells a single product with a variable cost per unit of 36. It has a contribution ratio of 25%. The company has weekly fixed cost of 18,000. Which of the following is the weekly break-even point? Direct substitute that and then break-even point. We are asked to find out about the number of units. The formula what we know is fixed cost by divided by contribution per unit. Now, if we have to find out what is contribution per unit, we do not have the selling price. Just please observe that a company manufactures and sells a single product with a variable cost of 36. That's given. Contribution margin ratio is given as 25%. So we will be able to find out what is break-even sales. That is 18,000 by 25% gives us break-even sales. To arrive at break-even units, the sales value divided by the selling price gives us number of units. So where do we have that selling price per unit? That is not there. So what do we do? Variable cost is 36. That is all what is given. So let's see. Sales, we see minus variable cost is contribution. We do not know any of these variables except variable cost, which is 36. We do not know sales, we do not know contribution. But these are per unit, and this is expressed in percentage. So the only thing what is given to us is contribution percentage is given to us as 25%. Sales is always the base, which is 100%. If 100% is sales, contribution margin is 25%. So variable cost is 75%. If 75% represents 36, what is 100%? What is 25%? So that can be calculated. So check that. If 75% is 36, 100% is what? So 100 into 36 by 75. Then similarly, I mean, we can now deduct selling price minus variable cost and arrive at contribution, or use the same logic. 36 into 25 by 75. So that will be 12. Now, can we find out? Yes, we can find out about what is the break-even point. Fixed cost is 18,000. 18,000 divided by 12. 1,500 units. Is the student entering now only, Abhi Panakal? Question number 89, next one on the screen. A company makes a single product with the following data: selling price, material, labor, variable overhead, fixed overhead, profit per unit. Budgeted output is 30,000 units. In relation to this data, which of the following statements is correct? There are 4 options given. They are not asking us any particular thing to calculate, but which option is correct is what is asked. Already one AB Panakal is there. Just now I have allowed to enter. One more is there in waiting. Let's see what is this story also. Now, whenever such a question comes about which option is correct, what do these options talk about? We have to look into all the options. Which one is correct is not known to us. So we have to work out, test all these things and then select the right one. A bit says margin of safety is 40%. So calculate first margin of safety and check whether it is 40%. B's contribution to sales ratio is 24%. C's volume of sales needed to make a profit of 270,000 is 45,000 units. Budgeted sales to increase 40,000 units. Budgeted profit will increase by 100,000. Which one is correct is not known. So what should we do? We have to work out on all of them. All the options have to be worked out. The first one, A option talks about margin of safety. So what is margin of safety? Budgeted output is 30,000 units. Then if budgeted output is given to us, at the budgeted output of 30,000, we have the details given. Uh, the selling price, the other costs, all of them. If margin of safety percentage has to be calculated, so margin of safety percentage is equal to the, according to the formula, we have in the numerator margin of safety divided by budgeted output into 100. But what is margin of safety? Margin of safety is equal to what is break-even output? Is equal to total fixed cost divided by contribution per unit. So let's see what is total fixed cost. Is equal to 4 is per unit into, this is at 30,000 units level, is equal to, we see that it is 120,000. Contribution per unit is equal to selling price is 25, 25 minus all the variable costs. What are the variable costs? Material is one variable cost, labor is another variable cost, minus variable overhead is another variable cost. So all of them are deducted. So how much do we have? 10, 15. So this is 10. Find out break-even output. Now coming to what is margin of safety percentage. No, first we have to calculate what is margin of safety. So margin of safety is equal to, the budgeted output is 30,000 minus the break-even output is 12,000. So that comes out to be 18,000. Now calculate what is margin of safety percentage is equal to We have it as 18,000 divided by 30,000 into 100 is equal to 60% is the answer, but the option is giving us 40%. So that's not true. A is not true. Um, this is about A. A is not true. Do we have time? Quickly, let's finish it up. B. Let's take option B. B says the contribution to sales ratio is 24%. So the contribution we got it as 10. Sales is 25. So 10 divided by 25 is equal to. This is 40%, not 24%. So B is also not correct. Then coming to C. C says the volume of sales needed to make a profit of 270,000 is 45,000. So let's see. Desired sales is equal to the numerator is fixed cost plus profit divided by contribution per unit. So we know total fixed cost is 120,000. We know the profit margin which is given is 270,000. So let's substitute this one is equal to 120,000 plus 270,000 divided by contribution margin per unit is 10. So that is equal to 39,000 units. So this is also not correct. So let's check whether D is correct. So D, if budgeted sales increase to 40,000 units, budgeted profit will increase by 100,000. So at present they have 30,000 units level. If they increase by 10,000 units, the budgeted profit will increase by 100,000 is what they mentioned. So let's have a tabular form. The present level or budgeted level. Then we have just the proposed level. At present, how many units are they selling? 30,000. Then 40,000 is the proposed level of units. These are units. Let's straight away start with contribution. Contribution per unit is known to as 10. So contribution is equal to 30,000 units into 10. Similarly, 40,000 units into 10 is the total contribution. What is total fixed cost? We already got it as 120,000. So whether it is 30,000 units or 40,000 units, it would remain the same. So what is profit? So is there increase in profit is 100,000 only. So earlier it was 180,000. Now it is 280,000. So the increase in profit is 100,000. So option D is correct. Increase in profit. This one question has covered so many bits about what is margin of safety, what is desired sales, um, contribution ratio, break-even point. All of them are covered here in this particular question. So I hope it is clear. Tomorrow we'll start with the new topic, that is limiting factor analysis. Is that clear? Any doubts? Who's absent today? Who's absent today?
Ma'am, Harshad and Sahil are absent.
There was one student who entered. He's not there now. Abhi something.
He is not in our class.
Who's he then?
Don't know, ma'am.
How is it possible to enter through LMS? Anyone from faculty? Okay. Just mention the names. I'll make a note of it. Please mention the names. Harshad and Sahil. Done. Okay then. Good day. See you tomorrow.
Thank you, ma'am.
Thank you.
Thank you, ma'am.
Thank you, ma'am.